If you're feeling whiplash from these markets, you're not alone. Corn is trying to grind higher. Soybeans just bled lower again. Cattle took a hit and hogs are slipping, while crude hangs under $63. All of that sets up one uncomfortable question for producers tonight. Are we looking at routine noise or early stages of margin squeeze heading into spring? Over the next few minutes, we're going to talk through grains, livestock, energy, weather, and the key headlines that move sentiment. I'll hit the prices first, but the real focus is the pressure points, where things could break in your favor and where they could turn against you fast. Stick with me to the end because the bigger story today is how these pieces link together into a risk map for your 2026 decisions. Let's start with corn. March 2026 corn futures are last trading near 431 3/4, up about a half cent on the day, with a daily range from roughly 429.5 to 432 3/4. That's a modest green number on the screen, but it caps a move where national average corn has been hovering in the low 430s per bushel after bouncing off multi-month lows. The pressure point here is that USDA still shows comfortable ending stocks north of 2 billion bushels, even after inching export estimates higher. Demand is improving, but not at a pace that forces rationing, so rallies can stall quickly when the market senses farmers selling. If you're sitting on an old crop or planning early new crop sales, the risk is assuming every 5 or 10 cent pop is the start of a runaway rally instead of a short covering bounce. What could change the tone in the corn? Two things in particular: South American weather and the next WASD or quarterly stock surprise. Brazil's harvest pace and any late season weather stress will either reinforce the big crop narrative or give bulls a fresh story at the same time. Any sign that U.S. exports are outpacing expectations could pull carryout down faster than the markets currently assume. Traders are watching whether this market can sustain closes above the mid 430s. Failure there keeps us in a sideways, grindy pattern that punishes late sellers. Moving to soybeans, March 2026 soybeans are trading near 1134 per bushel, down around 2 to 4.25 cents on the session after a strong week prior. Over the last month, beans are still up more than 8%, roughly 9% higher than a year ago, driven by renewed export interest and China signaling bigger U.S. purchases. The risk here isn't so much price collapse as it is volatility around policy and export headlines. President Trump has talked about China lifting soybean purchases to 20 million tons this season and 25 million the next season, which has fueled optimism, but follow-through must show up in the export sales book. USDA's latest data still shows total soybean commitments running about 20% behind last year and lagging the 5-year average pace. Even after recent improvements, that gap is the tension. Futures have already priced in better demand, but the shipment pace has to keep proving it. For a producer, that creates a window. The board has rallied enough to make cash sales pencil better than they did a month ago, but it has not yet broken into a new high-priced regime. This is where tools like scale-up cash sales, short-dated puts, or minimum price contracts can protect the floor while letting you participate if China actually delivers on those higher import targets. Chicago soft red winter wheat is trading near 309.25 on the March contract, up about 2 cents on the day, with a daily range between roughly 306 and 312.5. Wheat remains the laggard in the grain complex, with global supply still ample and fierce competition from the Black Sea region. The key risk in wheat is basis and quality. Futures can look cheap while local cash bids stay stubbornly weak if exporters don't need your origin. For wheat growers, the strategy conversation centers on acreage and rotation decisions. If these prices don't improve into your planting window, the incentive grows to shift marginal acres into other crops where demand looks firmer, especially soybeans. The consequence for the broader market is that a meaningful acreage shift could tighten wheat balance sheets in 2026-27. But that's a story the market may not reward until later in the year. Let's move to cattle and hogs, where today's tape was notably softer. Feeder cattle futures for May 2026 are last trading near 358.63, down about $1.28 on the session. after trading between roughly 357.93 and 362.10. April 2026 live cattle are trading around 240.40, down about a quarter, with a range today from just under 240 to about 241.68. Lean hogs for April are last near 91.33, down about 50 cents after bouncing between roughly 91.13 and 92.38. The cattle complex has been under pressure as futures back away from recent highs, while cash trade remains sluggish. Boxed beef values have been mixed, and the latest Fed cattle exchange auction saw limited buying interest at bids near 240 live. The risk here is that packers are signaling they're in no hurry, while feed yards face stubbornly high cost for corn, hay, and other inputs, even with corn not far above 430. Managed money still holds a very large net long position in live cattle, over 100,000 contracts, which adds another layer of vulnerability. If those funds start liquidating on any bearish demand, surprise or heavier than expected carcass weights, futures can break faster than the underlying cash market, leaving unhedged producers exposed. This is the sort of tape where protecting downside with puts or LRP insurance can be more about staying in the game than trying to outguess every tick. Feeder cattle are caught in the crossfire between board prices, cash calf markets, and feed cost. As corn has stabilized and even firmed slightly, the cheap feed story is less supportive than it was when corn was flirting with the low 420s. Cow-calf operators looking at fall marketing need to stress test budgets against both lower feeder futures and the possibility that feed remains sticky rather than collapsing. Over in hogs, April contracts have extended losses into the weekend, with the board giving back ground as traders worry about demand and heavy supplies. USDA data has shown relatively soft export movement in some recent weeks. While domestic pork demand is facing competition from cheaper poultry and beef price promotions, the immediate risk for hog producers is margin compression if futures keep sliding while feed and other costs don't follow. For hog risk management, the focus is on locking in any remaining positive margins where they exist and avoiding the trap of waiting for a big spring rally that may not materialize. Spreading sales across time, using protective puts, or capturing any basis opportunities that arise when packers need nearby supplies can help smooth that volatility. Turning to energy, March 2026 WTI crude oil futures are trading near 62.81 per barrel, down about 3 cents on the session after swinging between roughly 62.14 and 63.26. Crude has been stuck in a band around the low 60s, balancing concerns about global growth with ongoing production restraint from key OPEC members. For agriculture, the consequence of sub-63 crude oil is twofold. On one hand, it limits diesel price spikes and keeps some lid on fuel and freight costs, which helps your operating budget even as other input creeps higher. On the other hand, cheaper energy can weigh on ethanol and biodiesel margins, indirectly pressuring demand for corn and soybean oil if blending economics turn less attractive. Traders are watching whether crude can hold this floor if economic data softens, or if geopolitical flare-ups tighten supplies enough to push prices back toward the 70s. For producers, the key is to keep an eye on both local diesel bids and how energy policy shifts under the current administration could alter biofuel demand after the next 12 to 18 months. Let's layer in weather, because that's where the quiet days can lull you into complacency. Recent conditions across major U.S. growing regions have been generally favorable, with adequate soil moisture in many areas and no widespread immediate production threat. At the same time, seasonal outlooks hint at ongoing pattern shifts that could bring periods of excessive moisture in some zones and lingering dryness in others as we move toward planting. The cause and effect chain here is simple but powerful. If spring arrives wetter than normal in key Corn Belt states, planting delays can push more acres into shorter season hybrids or even shift some ground from corn to soybeans, tightening corn's balance sheet slightly while boosting bean supplies. Conversely, if the pattern flips to a drier, warmer bias, planting can run ahead of normal, which tends to bolster yield potential unless it sets the stage for summer heat stress. What traders are watching is any sign that the long-range forecast moved from mixed risks to a clear directional threat, either a significant drought signal or a prolonged saturation pattern. Until that happens, weather adds background noise rather than a dominant story, which is one reason grains are grinding instead of exploding. For your decisions, this is a good time to map out what-if scenarios. What happens to your marketing plan if yield potential shifts 10 to 15% in either direction? Now let's hit the key headlines shaping sentiment and what they could change for your operation. In story 1, Chinese soybean demand and U.S. export competition. Futures rallied recently after President Trump indicated China plans to lift U.S. soybean purchases to 20 million tons this year and 25 million next year. That has encouraged the market to price in stronger export pull, but USDA's own export sales data still shows total commitments roughly 20% below last year's pace and behind the 5-year average. The risk is that if China's buying pace fails to catch up with the promises, soy futures have already done a lot of work and could be vulnerable to a sharp correction. For producers, this is a classic example of headline risk versus ledger reality. On farm, you can respond by using recent strength to add incremental sales while using options to defend against the surprise upside breakout if Chinese buying suddenly surges. Traders will be watching weekly export sales reports and any shift in Brazil's competitiveness that might redirect business away from the U.S. Story 2, funds positioning in cattle. Latest CFTC data shows managed money holding a net long position in live cattle of over 108,000 contracts, even after trimming nearly 6,000 contracts in the most recent week. That big speculative stake has helped support the market on rallies, but it also raises the risk of a downside air pocket if sentiment turns. A negative shock, whether from weaker boxed beef, heavier carcass weights, or consumer demand cooling, could force funds to liquidate quickly, pressuring futures faster than the underlying cash trade moves. If you're marketing cattle into this environment, the consequence is that your price risk isn't just about supply and demand anymore. It's also about money flow. Tools like floor establishing puts or structured contracts with packers can buffer you if the board falls apart on the fund swelling while cash values move more gradually. Story number 3, soybean crush and product demand. Analysts are looking for January soybean crush around 218.5 million bushels, with soybean oil stocks near 1.71 billion pounds ahead of the next NOPA report. Strong crush margins have been a supportive pillar for soybeans, with processors bidding to secure supplies even when export demand wobbles. But if oil stocks build faster than expected or mill demand softens, that pillar can weaken and futures may have to work harder to attract incremental buying. For soybean growers, the key watch item is whether domestic crushers keep running hard into spring. If crush slows or oil stocks climb above expectations, basis in some regions could soften, changing the calculus on whether to hold bins full of beans waiting for a higher board. Story 4, broader grain balance sheets. Corn inventories remain historically comfortable, with USDA highlighting record December 1st corn stocks and a carryout above 2 billion bushels despite improved exports. That's a key reason rallies have been capped. The market doesn't yet feel compelled to ration demand. The consequence is that producers may face more trading range behavior, rallies that stall before they feel satisfying, unless a production problem or a bigger than expected demand surge shows up. Finally, story number 5, holiday schedule and liquidity. Markets will be closed Monday for President's Day, giving traders a long weekend to digest positions, while volume tapers into the close. Then pre-holiday trade can exaggerate moves in either direction and often sets up gaps when trade resumes. If you have orders working, be aware that fills and price action around the holiday may not fully reflect underlying fundamentals. As we wrap up, zoom out to the bigger picture. Grains are stuck between a big supplies and slowing improving demand. Livestock is wrestling with high cost and heavy speculative positions. Crude is quiet, but still influences your fuel and biofuel economics, and weather hasn't yet picked a clear side. The common thread is that risk is building more quietly than dramatically, giving disciplined producers a chance to plan instead of panic. For your operation, the most productive move tonight isn't predicting whether futures will be in a month, it's sketching out your triggers. At what price do you move the next 10% of old corn crop? When do you protect downside in cattle or hogs if the board slips another few dollars? And how we react if weather or export headlines suddenly flip the script. Answering those questions ahead of time is how you turn market tension into opportunity instead of stress. That's it for today's Boots and Bushels. I'll be back here again tomorrow.